Welcome, everyone. I'm John Ryan of the Predictive Playbook. Welcome to the Financial Futures and Trading Show. We'll be joined shortly by my good friend and pal, co host Steve Merrill of Wager Talk. Make sure you get over to Wager Talk and check out his profile, as he is one of the best in the business in the sports betting industry, and highly recommend him without hesitation. As you see in front of us, this is the S&P 500. And we have been looking at this chart for what seems to be about 6 weeks now, as the betting sentiment, the market sentiment, which is the same calculation I use for the betting sentiment in the sports betting markets. You know, when one team has too many people thinking that that team's going to win, it oftentimes doesn't pan out. And what we're seeing here, at least in the initial call here on the market, is that we are getting pretty frothy. And just let me pull up the other slide here. We had a big downdraft yesterday. We're up quite a bit earlier today, but now we're starting to lose steam. And I'm starting to really wonder if this is not the beginning of a top. And that's the one advantage with candlestick charts, is that they do a great job in providing almost immediate understanding of where the market is going to go, and how fast it's going to change, or how fast it's going to move in a continued trend, as we will see shortly with Bitcoin. But in this S&P 500, I'm going to shorten the duration here. We had an inverted hammer at the top. That was your first warning sign right there. And then the downdraft here is pretty big. We did recover, so you have a bit of a wick here. It's certainly not another hammer or even a bullish hammer, but we really need to stay positive today for the trend to still remain quite strong to the upside. I know I read a report yesterday that one of the research firms suggested that the market could continue higher for another 30% increase over the next 12 months. And that was a head scratcher, because what we're seeing now is a stabilization of the Fed, not tightening anymore, but at the same time, they're not exactly loosening, even though the market has priced in 3 to 4 25 basis points easing for this calendar year. So we need to start seeing that relatively soon for the market to continue higher. If the inflation numbers come out of the woodwork and they become higher than expected and higher than the economists' forecast, then we're going to get a pretty good correction here in the market. You can't have market sentiment cruising at 88, which it is right now, for extended periods of time. And it has been doing that now since January 22nd, when it reached above 85, without some sort of downdraft that occurs. We saw on the previous chart, the first one, that when we get to these levels, and conversely, when we get down into the 20s, which has been the case with crude oil, unleaded gas, heating oil markets, that a bounce is sometimes imminent. It's not guaranteed, but it's more likely to bounce higher than it is to continue down that trend. In fact, let's take a look at the crude oil right now, because this is another market that was the opposite. You can see that the sentiment here got down as low as, into the teens, and for a sustained period of time, but the price action began to move sideways. There was no confirmation that the bear trend that started here was going to keep going down to lower levels, possibly as low as 50. And again, the candlesticks give you early warning or early opportunity, shall we say, to consider, a buy in this situation. And we do have that right now. The sentiment's still very low at 30. But again, the fundamentals don't support a big bull move in crude oil or unleaded gas or heating oil. And if anything, this area where we are right now, as you can see when I enlarge it, is a very difficult area for the market to get in. Every single time it's gone up into the high 70s, it's been met with aggressive selling pressure, some really heavy selling pressure, liquidation of longs, and you can see what the result has been. So here again, we have a market that almost traded 79 this morning, is now challenging breaking through 77. And that is in large part because of the pressure that is now being seen on the Dow and the S&P 500 futures. And back here we have almost an engulfing candle. It was an engulfing candle based on open and close, based on the candle, not the wick, and that was bearish. Then we had basically another engulfing candle here, and then continuation selling. Doji here, which it looks like a cross. That's where the open and close are the same. That generally can point to a trend change, short term. Again, not always right. But this pattern right here, it's developing today at inverted hammer. If we finish low of the day, it's very likely that we're going to get further selling pressure the rest of the week, Thursday and Friday. Welcome to the show, Steve. How you doing?
Hey, John, great to be here. Yeah, it's a
Yeah.
good time to do a show after yesterday for sure.
Oh, it is. No question. I was just going over crude oil, which is right there on the chart that you're seeing. I already mentioned that the S&P 500 was sentiment as bullish as it is. There doesn't seem to be any fear. Nobody really is concerned that we are due for a correction, and everything is just dandy. And that's usually when we get these downdrafts. And crude oil today is really putting in a bearish pattern, trading almost up at 79. And now, just moments ago, I said we were 77.10, ready to break through 77, and now we're at 76.91 live. And if that continues to finish lower and lower and close on the low, you could see a pretty big move tomorrow in crude oil, another $2 or $3, maybe even on the opening. It's a very powerful signal that we're getting here. So we'll be looking at put options of the probably about the 74 strike, and we'll just have to see what happens then. But I think that's one of the better ones I've seen since we started doing these shows. What do you think about the S&P 500? And I know you love talking about the fundamentals too. Did you know that the federal government, the deficit right now, they pay 1.8 billion per day in interest? I mean, it has to stop somewhere, right? Oh, you're muted. Wait. I don't think I muted you. Well, we lost him there just for a second. He'll be coming back here shortly. Maybe it's the aftermath of the winter storm in the East Coast. But anyway, I'm sure he'll be right back here. But again, he knows the budget stuff and the fundamentals and inflationary trends better than most for sure. And while we're doing this, I can pull up a little chart that is DraftKings. And this is a stock that I think is going to do well, regardless if the market tanks or not. He must have had technical difficulty because he's not back on yet, which is quite a bummer. Anyway, we'll move on here. He's back.
I'm good. Yeah, I think the microphone got crossed up there, so I just rebooted.
Okay.
My end. The powers that be didn't want to hear the great insight we're going to give here on the show today and how to make some money in the markets. What I was saying was I actually read a great article the other day in Reason Magazine, which I like. It's kind of a libertarian, free think type neutral magazine. And they were talking about how, the argument's been for years that the deficit wasn't a problem because interest rates were 0, 1%, and we could pay the debt back cheaper than the GDP. But the one problem with that argument is when rates all of a sudden get back up to anywhere near a normal level, which is what's happened. And that's to your point. It gets exponentially more expensive every point that interest rates rise. The problem is they can still get by the next several years. And every politician basically, every congressman is elected every 2 years. So they have no incentive to worry about 30 or 40 years from now. But the article was fascinating, and it just shows what a quagmire this is going to be in 20, 30, 40 years. And that's assuming rates stay modest, and they can't get much lower than they've been. So this is a mess. And I think actually the takeaway for me is that we're going to end up like Japan. So if you really want to see a big picture like trading strategy, Japan in the 80s had a lost decade, a stagnant economy. Their stock market was roaring, yet they're still like the second biggest economy on earth, I believe, after the U.S. still. So doesn't mean the U.S. is going to crash. It doesn't mean we're going to turn into Greece, but we're going to be stagnant. So if you're stagnant, you're getting 1 or 2% returns in the stock market instead of 10% for the next decade. And there's a lot of metrics based on the the Cape value and the price, earnings ratios and whatnot, where that is the long-term expectation, especially in real returns. So the fact that the market has soared, so much, 40 some percent in the NASDAQ over the last year, we're going to have some corrections. The problem is they come so fast, like yesterday, that you sometimes don't have time to react if you're trading like a weekly or monthly strategy. And that's what gets tricky. We saw that with Bitcoin as well. Bitcoin, when they would make those moves, it'd be like one day, boom. And it's very difficult to get in, get out. And that's why the markets move like that now. But the inflation numbers obviously yesterday showed that maybe it's not over. And that means the rates probably are maybe not going to be cut like everybody thought. And that's going to be a huge problem for the deficit if that's the case.
I agree 100%. I remember, I think it was, I don't remember the exact date, but I remember when I was working on Wall Street, it was one of the first times I was buying Japanese bonds at negative interest rates for an institutional
Yeah.
account. It was an endowment fund. And even though I knew why they were negative and why I knew this was a great investment, it's still hard to get your hands around. And if we ever do get to that negative interest rate level like Japan did, there's going to be reasons why. They're probably pretty good investments, and it has a lot to do with the exchange rate of the dollar versus the yen in this case, where the dollar was just getting stronger and stronger against the yen, which when you liquidate the bond, then you get the benefit of the appreciation in the underlying currency that offsets the negative interest rate. So there definitely are reasons why you get negative interest rates. And if you bought bonds now and we went to zero, that would be a home run, Steve. I mean, people just don't necessarily understand the power of a 10-year and 30-year bond and the value of a 30-second and things called McCullough duration, which compares 30-year, 10-year to 2 years, vice versa. There's all kinds of things that confirm that buying bonds at this level is probably good, and you don't have to hold them till 30 years. You can sell them tomorrow.
Well, John, what's your take on why the 2 and 10 years have been paying more than the 30-year? I mean, what's your take on that? Why that's like 5.5 versus 4.5? I mean, there's different reasons why. What's your theory on that?
Well, normally that points to a recession. When you get
Yeah.
the 2-year above the 10, that inversion of the yield curve usually does portend to a recessionary time. But we have a pretty strange economy here. I think what's being masked is the power of AI in that industry. I think that has a lot to do with us not having a recession from the Fed increases in rates over the last year that normally would cause a rather abrupt slowdown in the economic activity. So that's another concern too, is that we have a lot of things going on that are masking what the real underlying truth of the economy is.
I'll tell you another interesting take on the 30-year being at 4 point something, and the 2 or 10-year, the 5-year being over 5. Normally that would mean if things are going to be healthier later. But I saw an interesting take in that article as well, saying that the other way you could look at it is that the market thinks inflation is going to be here for a while and going to be getting worse for decades because
Yep.
I think about a month or so ago, they had a 30-year auction and they didn't even sell all the 30 years. I don't know how often that happens. You would know better than me.
It's
But
rare.
yeah, exactly. So the fact that people did not want to buy the 30 years could also mean because they don't think their money is going to be worth nearly as much a couple decades from now. And that goes back to that national debt issue that you talked about. So I think that's another way to look at it. I thought that was a very interesting way to look at it, but it could be a bigger problem than people realize. But as always, they're kicking the can down the road. No 2-year congressman's going to care about dealing with it. And the average American has debt, so they don't care about it either. So they're not going to hold the congressman accountable because the average American's not financially responsible either. But at some point, this has to affect the markets. And, I don't think yesterday was the showing of that necessarily, but we're going to maybe see more sporadic down days like that over the next several years.
Yeah, we sure are. That's a Bitcoin chart there, and we're approaching the levels where you and I both shorted it. 60,000. I think the other one was 58. But I don't know if the third time is the charm, so to speak. I'm almost thinking I'm staying out of the way of even entertaining the thought of
Oh
a
yeah, I
short
mean,
opportunity until more is out, because this market could be explosive. It's thin enough that liquidity is not like buying and selling Apple Computer or Microsoft or any of the big Dow 30s. and you could get one hellacious short squeeze from the CME futures on Bitcoin that would propel more people to get involved with, oh, I got to buy it now. I can't miss it. It's going to go to 200,000. Remember when it opened up? That was the highs you have said before in the futures market at 20,000. And at that time, everybody and their brother, I mean, I could walk into a local store or a local pub, and there'd be people, talking and saying that, oh yeah, I own it at 15,000 and it's going to 400,000. And I just was like, whoa. And when you start hearing that kind of talk, and that was a long time ago now, but that is number one red flag when the public is in a pub atmosphere, or you just hear it anywhere, Starbucks, and people are in agreement that this is like the golden goose, and you can get it at 15,000 because it's going to 400,000. Well, it went up, but it got to 60, and then it went all the way back down to below 20.
Yeah, well, that 20 was definitely the key support level. We talked about it because that's where it first was 5 years ago when the future exchange opened. And that the reason I would definitely not be looking to get short anytime soon is, first of all, just look at that upward trend over the last 6, 7 bars there. I mean, it's just pure
Yep.
green, and it's also broken out all the recent highs. And then the biggest reason is because when the ETFs went live, I really did think it might be a buy the news, sell the reality type situation, and it hasn't happened, because that is what happened, like you said, when the CME started back in 2016, I believe, or 17. And the
Yep.
fact that it's broken out and held now several weeks after those ETF funds went live, maybe we'll get a little bit of a retracement, but I would say that mid range there on the chart is probably the new low, the new support, because it's kind of like a gold, and a lot of these, funds have to hold it, and a lot of other investments are holding it. So it's a semi commodity almost at this point, I think, where that 20,000
Yeah.
was definitely the low, and now it could be 30 or 40,000 might be that new all time support level. And it's just a matter of how high up and how much it bounces up and down between, like it did, the last few years.
Yeah, I agree 100%. I think, yeah, I wouldn't be surprised if it doesn't pull back below 45,000. Yeah, 45,000 over the next several months. I mean, the low for the year might have been right in here. Um, it's really strong, but I just can't bring myself to buying it.
No, I'm not. Yeah, I'm not saying to go buy it either. It's definitely a breakout, but it's going to pull back at some point. But when it does pull back, it's probably, if you are looking to buy it, you want to wait for a pullback. If you miss it, you miss it. But
Yeah.
I think one of those levels on the mid chart, either the top there or that bottom red, like you pointed out, somewhere in that range is going to be the support level.
Yep, I agree. Let's take a look at natural gas and see how that's doing. It's been one of your favorites, and look at this. What the heck happened to natural gas?
Yeah.
Yeah, it's not even a changeover from the futures month. I thought maybe we went from December futures to March, but
Yeah, you once
yeah,
again, though, you see that key support level from several bars was broken, and now it's completely down. And once it breaks things like that, it usually starts running that direction. That's why it's so important to have the tight stop losses, and that's what we had talked about. The downside risk was minimal if you had a tight stop loss. It had unlimited room to run to the top, and it just didn't happen. But there again, you're only talking about a small loss with big risk reward. But at some point when this stabilizes again, you're going to have a nice little chance, to have a long side breakout, because you look at those recent highs from just within the last year or two are substantially higher. But this is definitely a downtrend right now that you don't want to try to fight. This is the definition of a falling knife. You're not trying to catch this right now.
yep, yep, and borderline capitulation. Another word you and I like.
Yep.
This is beginning to look like the dead cat bounce for sure.
It's just,
Wow.
and once again, for the new viewers, one of the reasons the risk reward is so good on this, it's not a financial stock. A company can go to zero. I mean, it's a commodity.
Right.
It's a very important commodity. And I know technology and whatnot, they're finding more of it than ever, but still at some point it's got a value. And just look how much it was worth within the last couple of years. And granted, those probably weren't accurate prices, but then again, it just shows how extreme the market can get. It got way extreme to the high and it corrected pretty fast a year or two ago. I'm not trying to catch this falling knife. It needs to bottom. We need to see it turn over. But I would say we're probably going to look back in a couple of years and see where we are right now and say, boy, that was a pretty extreme low.
Yeah, I think I agree. I think this is where we start looking at ETFs. But definitely ahead of the next show, for example, because this does have the hallmark of a capitulation situation. Sentiment is now down to 20. Back here, I think it was like 60. Yep.
Yeah.
So when we start getting down 20, we saw that in crude oil.
Well, it's just there's no sellers left. That's exactly
Right.
why. When that's what people forget. I mean, you know it obviously, but it's just that's why the sentiment indicators do work because it's a zero sum. You got to have a buyer for every seller, and if there's no sellers left, and when you see that many reds like that breaking through a key support level, um, that is usually capitulation.
And here we are. This is crude oil sentiment 15 on January 5th. And now we haven't gone up a ton, but if you're trading futures, this is about a $7,000 move per contract from here to where we are now.
Yeah, and you haven't lost money. At no point were you ever down after that bottom. And I'd like to watch just the sentiment, the curve itself. You could almost use that once that turns upward is another good way to kind of play the trend as well. And you can see it pretty much was that middle of the chart right there is kind of bottoming and started to turn upward. Even if you got in a few weeks later, at that point, um, you really haven't had that taken out yet. Can you pull that natural gas up again? Because I mean, there again, I think maybe wait until that sentiment indicator starts to roll over because I think that was kind of in a downward slide, wasn't
This
it?
before I do, this is an engulfing candle now. It's a huge inverted hammer. So we just traded a couple cents below yesterday's low. Now I would obviously like to see it close like 76.50. But I think as soon as this show is over, I think looking at the 74 puts for March is probably a pretty good risk reward opportunity. And full disclaimer, what we talk about is our personal ideas, and there's no guarantee ever that our ideas are going to make money for anybody who wants to tail along. We're just trying to provide some thought-provoking conversation, and today we certainly have it. And this is very concerning because that means that an S&P 500, where we did have the downdraft yesterday, and what I was saying earlier in the show before you came on is that we bounced back up, but it's starting to fail. And if this green candle ends up being a negative close,
Right.
tomorrow could be the post Valentine's Day massacre, I guess, for lack of a better word. I'm just a little nervous, and I hope my nervousness is not.
And John, look at all these look at the big reds, like the one a little bit back and then the one in the middle of the chart, like the two biggest other red downs, that one and then that one right there. Both of the following days were up like today, and they didn't go below that close, that red close. And that's exactly where we are now. So I really do think that's something to keep an eye on because that's the definition of an uptrend is higher highs. You're not getting lower lows. And we haven't had any lower lows in a long time.
And here's the natural gas.
So now explain the yellow line to everybody again, because you can see it hasn't quite rolled over, but it looks like it's about to, though. It looks like it's about to flatten out there.
This one here?
Yeah, the sentiment.
That's sentiment. So when we're
what goes in? Explain what goes into that sentiment indicator.
Well,
though.
it's basically simplicitly said, it measures the percentage of bulls, percentage of bears. So in the sports betting markets, for example, if you follow those, which Steve and I obviously do, you can get games where there's 75% of the tickets bet on a team. And that's a red flag because it's too much irrational exuberance that team is going to win easily and that the books are essentially giving you free money, which they don't do. And the market on this chart is not going to give you free money either. Even if it looks too good to be true, it's not that easy.
But what are they basing on to get the percentage of bulls and bears? Because there has to be a buyer for every seller. Unlike the sports betting market where they could take 10 bets on one side and one on the other, there has to be a buy and a sell in every single trade. So theoretically, it should always be 50-50. So is that basically the orders that are being put in?
It's think of open interest in options. If somebody's buying and it's initiating a position, and that contract that is being offset is one of liquidation, that adds more longs to the market. So there's a commitment of traders report that the Chicago Board of Trade puts out in the Chicago Merc, and that shows you what the the various traders, from small traders to institutional traders, almost like the pros and the Joes in the sports betting market, and what their net position is. So then that establishes whether the market is gradually getting more bullish or bearish. So when we start coming down here, like here in natural gas, this to me, combined with this indicator, the sentiment, is that we're seeing mass liquidation of longs, and that there's not really aggressive shorts coming in here necessarily, but we're seeing liquidation of longs. So the longs that bought back in here or whenever they did, this is liquidation. So based on that, there would be fewer contracts outstanding um, as a result. So that's why I was talking about open interest with options trading.
Sure.
You every trade that's a new one is another contract that's added to the pile. So this is a classic example of liquidation of longs and everybody just getting the hell out of the way.
So now, if someone has charting software or just a general trading account, that yellow line, is that a proprietary one that you're using, or is that one that's in a
Yeah,
lot of the?
yeah. But if somebody wants me to help them create one,
Yeah.
I have no problem doing that. So it's just math, and it's taking numbers from what I was just talking about. But I do think like looking at commitment of traders report is an excellent starting point. Um, and RSI, relative strength index, that's another basic. It's been around for decades.
Right.
So relative strength measures how strong the market is, and it's basically the same thing like an oscillator. That's what you're basically seeing here is an oscillator going up and down, and usually runs parallel with the markets, but we get times where it's not. Um, so that I think that RSI would be a great one to look at, and then there's a whole bunch of others that we can talk about next week, maybe, and show examples of them. And that way, I can. I have no problem showing what this market sentiment is and how it's calculated. Um, we can definitely do that next week, or if we do another show this week, we'll do it this week.
Yeah, I think it'd be something that's worth using because if you really follow it, it makes so much sense because the bottom line is buyers and sellers dictate which way the price action goes. It's that simple.
Yep.
If you can know that someone get a handle on that, I think it's something people vastly overlook.
Yep. And how bad do they want to own it? That's the other thing. That's market chasing, which you really don't want to do ever. But that's what I'm fearing with. Well, not fearing. That's what I'm seeing with Bitcoin, and
Right.
you more or less agree with that too.
Yeah,
And
no,
this is
that's
the
no
opposite.
question
It's like,
about it. I mean, they normally run higher than they should and they go lower than they should. And that's why you don't try to catch that falling knife because natural
yep,
gas is in a downward spiral right now. But it does look like that sentiment is about getting as low as it can get, which means at some point, not going to be many sellers left. Doesn't mean there'll be a lot of buyers either. And what normally does happen is when it gets to that point, it's usually a sideways channel for a little bit. And then finally, there's some momentum to the upside. But yeah, you're right. Bitcoin does seem like everyone at this point is a little late to the game, but that also doesn't mean that it's just going to roll over and drop the next day. If anything, it'll probably
right.
go a little sideways also.
Yep, I agree 100% with that too. Think of it this way, Steve. This kind of just hit me with our connections with the sports betting market and trading. And obviously, we've been trading a lot longer than we've been doing the sports stuff, but still, that this area right here is the Philadelphia 76ers over the last 2 weeks. They lost 8 out of 10, I think it was, right?
Right.
So every red is a loss. So the natural gas is on a 1, 2, 3, 4, 5, 8 game or 8 day, if you will, losing streak. And it's so similar. The connections and the mathematics between both markets is just uncanny. You just can't deny it.
Yeah, I
Here,
mean, and of
here's
course,
where
for the
Embiid gets hurt.
non-sports guys, they've lost. Embiid's been out there, the MVP from last season. It's a team that was basically a 70% win team that's been like a 20% win team without him. But
Yeah,
there again, the chart will tell you when they start playing, whether they're either going to learn to play without him or he's going to be back in a couple months. And when we look at that chart a few weeks or a few months from now, you'll see it start to turn up, and that would be the indicator. It's the same thing. And of course, with the point spread, they eventually have to adjust it, and they haven't been adjusting it enough because not only are they losing those games, but they're not covering the majority of them either, because they just haven't made enough of an adjustment. Same thing with natural gas. This will eventually hit a price point in which people don't want to sell anymore. And more importantly, they'll eventually want to start buying. And then there'll be a catalyst. I mean, the equivalent would be a star player coming back to the lineup in sports. There'll be a catalyst, then it gives it even more upside at some point.
Yeah, I mean, by analogy, and this is tongue in cheek kind of thing, but this gap here is the day that Embiid got hurt.
Yeah, exactly. No, that's what it would
Yes.
look like. Yeah, if you're charting the Sixers,
Yep.
especially their relative like point spread performance or margin of victory, that's exactly what it would look like. Yeah.
So maybe when he comes back, we'll have a gap up. We'll have to see the correlation between Joel Embiid and natural gas.
Yeah, you would think if he's out, he'd be using more natural gas because he's at home more often and running the appliances and stuff. So I don't know.
Yeah, we ought to look into that. Oh,
He's a
well,
big man. He's like 7 foot, so he probably needs to keep the house extra warm.
yeah, and he probably has higher than the normal ceilings too, which requires
Yeah,
more heat.
yeah, that's a great point. Heat rises. Yeah,
Yeah.
the tall ceilings definitely. So it makes no sense. Him being injured should actually jack up natural gas. So something's not right there.
This is we'll go through this in DraftKings and then we'll call it
Sounds
a
good.
day. But in the future, if you're listening to the show, just leave it in the comments section. Any tickers that you want us to address and give our take on it, our opinion, please do, because we enjoy that quite a bit. This is the UFC, EDR, basically a talent retaining company, and it's been moving sideways. But I do think that this is one of those stocks, along with DraftKings, that is independent of the economic cycles, independent of the tightenings. Of course, DraftKings has a boatload of debt. It's more like an aircraft carrier, but that's because they had to go in every state that was newly legalized and put their footprint in it. And that takes, hundreds of millions of dollars. And they've done all that now. And, they had a big Super Bowl weekend, and it's only going to get better for them. So this is the UFC. And I think here too, that anything, south in the low 20s, 20 to 22 range, you saw it down here at 18 at the beginning of the year. It's actually October. And then it has rallied since, but I don't see this stock really being correlated. They call it, the beta metric, where how close is the correlation between the S&P 500 and that stock. And I think you're going to see the beta on this increase, meaning that this will outperform the S&P 500 and will not mirror any downdrafts nearly as much. So if say we get, hypothetically, get a 20% correction, this may go down 5%. That's what I'm seeing with these. And then DraftKings, EKNG.
I mean, a big thing to think about still, that just say the S&P is, I mean, it's so top heavy with 6 or 7 companies making up a majority of it still. And they're going to be
Right.
the ones, Apple, Amazon, those are going to be the
Microsoft.
ones that have to be liquidated first in a drawdown. So I do think you can almost play like the S&P minus the top 5 or so and probably have a safer portfolio with less drawdown if something does go wrong.
Yep, I agree.
Be interesting to see yesterday, John. Actually, I don't. There's probably a way to find it, but be interesting to see how like the other 490 did yesterday versus the overall S&P. I would have guessed that 490 was definitely down less than probably
Yeah.
the top 10, but they've also not been up nearly as much over the last year. So it goes both ways. You wouldn't have the same return either, though. So
Yeah, and then think about it too with Microsoft. They're $405, let's say. They're a $3 trillion company. So now every single dollar move in market cap is much higher than Netflix moving $1 lower. That's something to keep in mind too.
but those
But
companies are
Microsoft
still at the
is
forefront of AI. Microsoft's probably the
right.
most, and that's so, like you said before, that is the one real X factor that could keep things going crazy, is that this is like the next internet, basically. It's the next, automobile, electricity,
Yeah.
internet. It could be that big here over the next century that, do you really want to be shorting those companies that are going to be making the Model T or, making the internet basically, because that's what AI could be.
Yep. No doubt. Absolutely no doubt there. So this is DraftKings trading, very close to the 52-week high. Went from $17 a share on April 3rd of last year and now trading 42. Very powerful trend. It may not look like that because it's steady as she goes kind of thing, except for right in here. But I think excuse me, I think this stock does have very powerful potential to significantly outperform whatever the heck the S&P 500 is going to do. So S&P 500 at year end could be exactly where it is now, say, for instance, but DraftKings will probably be in the 70s if that occurs. So if we don't get too big a correction in the S&P 500 in the remaining 10 months, then I do think DraftKings here is just going to keep moving higher and higher. Anybody who shorted this is now starting to feel the pressure to cover. And if they get another little shortcoming rally in addition to fresh buying from the, you know, the hedge funds, it's going to move pretty quick.
Yeah, and I mean, the thing with DraftKings too is you would think, well, if there's a recession or whatnot, that should be the first thing that suffers because nobody should be betting on sports. It's all discretionary income. But you and I know, if anything,
Yeah,
that first year or two of a recession, I think people bet more because they're chasing. So
yeah,
yeah, I think it'll be a lagging indicator. It'll actually probably hold on longer than the other markets for that reason, like you said. So it probably is a little bit of a safer hedge if you think there's some trouble coming in the next year or so.
yep. Any final thoughts here before we conclude the show? Yeah, I've been encouraging people to go over to Wager Talk and check you out. It's one of the best that I know of, and I'm proud to say that. So, stage is yours, and you can promote whatever it is that you want to promote.
Yeah, I mean, wagertalk.com is a great place to check it out. I've been ranked number one this entire basketball season, college and pro basketball sides combined since October. Won again last night, 3-0 so far this week. I average about 2 plays a day. I say 1 to 3, and it works out to exactly about 2 on average. So I'm very selective. Games that just missed the cut, I put up for free every day. So there's a bonus free play. So if you are new or you want to build your bankroll, don't miss out on those free plays. There's strong opinions or games that just missed the cut. And doing a ton of solo videos as well. I just did some earlier. Going to have a couple more here and then the college basketball show. So wagertalk.com and then Wager Talk TV on YouTube is a great place to get some free information.
Great stuff, Steve. You and I started in that business kind of speaking for myself, it's going to be like a short-term hobby. I felt like the industry needed some honesty and transparency and really some education on how it works in terms of grinding and going one day at a time and literally one game at a time, as you mentioned, 1 or 2 games, 3 games maybe per day, and that's how it gets done. That's how you make money. It's not betting 17 games in a day and hoping you win more than you lose. So yeah, 1998, I think it was, right? VegasExperts.com, which is still around.
Yeah.
Hard to believe.
Yeah. Things have changed quite a bit. I mean, you and I basically started pre-internet and now we're doing a
Yeah.
show on the internet. So it's pretty cool.
Yeah. And pretty soon maybe we'll wear the Vision Pro goggles on a
Yeah, I
show.
do want to find it. I will say I'm not a big Apple guy or a big tech guy in general, but anything that costs like $3,000 and has a payment plan as a pair of goggles intrigues me. So I am anxious if I can stop by an Apple store sometime in the near future. I definitely want to check them out. Apparently, that's the only place you can demo them right now is actually in the Apple stores.
Yep. Yep. And I'm sure they're pretty well protected from shoplifting too. Sad to
Yeah, I
say.
was going to
But
say,
that's
I
the
mean,
world we
it's
live
a
in.
high priced item now.
Yep. So that's almost as much as my MacBook Pro that I use for these shows. It was close to 4,000, but when you buy that kind of laptop, it's going to last like literally forever.
Thing is,
That was fun.
those goggles though will be better and cheaper in 2 years though. So that's why it's
Yep.
so hard for me to even consider getting something like that because it's the first edition, and they'll actually be less expensive and probably better. Technology is the only thing that gets better and less expensive. It's really remarkable. It's the anti-inflation concept. Nothing else is like that. Food never goes down in price, and even if we have a recession, it won't go down. Once the rates go up, it stays there. But yeah, I mean, you can get better computers, better cell phones, more powerful for the same, if not less, than they cost 5 years ago. It's kind of a remarkable concept, and that's another reason why the market and the economy does well long term because of the innovation. And that's why the AI, I'll leave it at that. I really do think the AI is the X factor here for the next 10, 20 years on how everything goes. The US, even with all their debt, they're still the innovators. And that's one thing China's never been able to do. They try to steal the innovations and knock them off, but they're not the innovators. They're the copycats. And once we lose that, John, that's when I'll start getting concerned. But
Yeah, I agree.
the AI still is the next big wave, and it looks like we're kind of leading the forefront in that. But when that stops, that's exactly when I think we might really have to get nervous because and Japan's a good analogy once again. They were the tech kings in the 80s, right before back when the computers started and all that stuff. So I think if you really want to predict how the US is going to play out the next 20 years or so, I think, study what has happened to Japan the last 3 or 4 decades. And it's not awful, but it's not great either. Just depends on your perspective.
Yeah, and come to think of it, they were always the biggest buyer in the 30-year bond auction. They couldn't get in
That's
the 80s
interesting.
and 90s, they couldn't get enough of them.
Now, is that after their cool down? Is that when they started to go dormant?
Pretty much, yeah. It was well, it was right in the 90s. You had the New York City recession, right? So they bought Rockefeller Center
Right.
at a ridiculous price and then sold it back to the same Americans that owned it previous at like I think it was 40% less. So imagine selling a building like the Empire State Building and then being able to buy it back at 40% less of what you sold it at.
Yeah, and that's why the Chinese have been buying up real estate for a
Yep.
couple decades now, farmland, which is a different subject because of it. We do need food. We don't have to have high rises, but we need food. So I think that gets a little bit of a national security issue. But that's another real interesting take. You do see China kind of doing that. And the real estate, I think yesterday's inflation report, cost of lodging or whatever was up more as much as anything. So there again, inflation would actually help those international buyers who are holding real estate and real assets. It's something else to keep in mind as well. It's an interesting dynamic. I'm hoping the one thing we have also is that we're too big to fail, where it would actually hurt China, would hurt Japan, would hurt our allies and enemies if we do fail. That it's the new Cold War. It's not a nuclear Cold War, it's an economic Cold War. Because once again, China produces a lot of stuff that we use still. It would cripple that economy also if they weren't making our stuff. So I think that's something that gets lost sometimes is that they have an economic interest in us as much as we have in ourselves.
Not too many countries can afford to pay 32 trillion to bail out the debt.
Yeah,
In fact, there's none. You're right. Too big to fail is certainly very real.
and I think that's the other argument on the natural. It's nothing natural about it. The national debt not being as big of an issue as it might seem on paper is that we don't pay. What are they going to do? That's what I've always said. It's like I mean that is one way to look at it, especially when they own some real
Yeah.
estate here and we're producing things. They're producing things that we sell. It's all right. We go under, you go under. It's almost as like how it is. So at some point you wonder if they'd work, if they take a loss on it, or take a cut. So I think there's a lot of creative things that can happen. But on average, if what's it come out to like $50,000 or $60,000 per household underwater if you spread out the national debt, it's
I think
just
it's over 100 now. I'll have to
it's
double
basically
check.
more than a year's of income for the average American then. So it'd be like every American having to give up an entire year of their paycheck. Which when you hear in those terms, you're like, how can this continue? But then again, it might just be monopoly money because they do print it. And but see, that goes back, and I'll leave it at this. That goes back to inflation. The one thing you can't get away from is inflation because you can print as much monopoly money and you can tell the other countries are not going to pay you back, whatever, but that money becomes less valuable. And that's another reason when the
Right.
30-year auction didn't fill, and you said that's pretty rare. That's telling me that people think that money 30 years from now is going to be worth a lot less and they're not going to tie it up, and that's
And
why
that
the 2 or 10 years are paying 5.5 and the 30 years paying 4.3. Something's not right about that.
Yep. And it also reveals the fact that the institutional investor thinks that the 30-year yield right now is closer to a low and is going to move
Good
higher.
point. Right.
Now
Because
that
it'll need to for the
probably
other reasons. Yeah.
and that probably happens because the appetite for a 2-year right now has got to be pretty high from the institutional accounts because the market is you look at a 10-year note, they've already that priced in at least 3 easings this year as where it stands now.
Right.
So I think that's more in addition to what you said is going on, but the 30-year could just stay rock solid between now and year end, and the 2-year drop um, significantly, and then you get the steeper yield curve, the more traditional one where the further maturities give out the higher yield. But
Yeah. I mean, it's hard not to cash paying 5%. I've said it for about a year now. And I mean, the stock market had a nice run last year. You would have done better in the market. But right now, with the uncertainty and like yesterday, it's hard to make an argument having a good chunk in cash at 5%. Um,
yeah,
and just for numerous reasons. You're not going to get hurt doing that.
I definitely agree.
That'll be my final trade for the show. Cash 5%.
Yep.
It
There's
ain't
nothing wrong
sexy.
with it. I mean, it
Yeah.
is smart. Well, anyway, Steve, thanks for being on the show, and we'll try to get another one in here. Maybe we can do it every week on the same day. We'll figure something out so we can get more information out to people, especially with the precarious situations we're starting to see that may not be reality, but they're certainly real right now. We'll just have to see how that pans out. But thanks for being on the show. Best of luck, of course, with the best bets for tonight. And always remember, people, bet with your head, not over it, and that includes investing. And may all the wins be yours.